Why I do not invest in real estate? Because of its low liquidity. See, liquidity refers to how easily an asset can be quickly converted into cash without significantly affecting its price. High liquidity means an asset can be sold quickly at its market value, while low liquidity means it might take longer to sell or could require a discount to sell quickly. Now, I like high liquidity, that is why I invest in mutual funds, not in real estate. Tom and Jerry were two friends who lived in a small town. And when they received their first salary, Jerry invested his money in a mutual fund while Tom kept his saving in a jar at home. Over time, Jerry's investment grew steadily thanks to the diversification and professional management of the mutual fund. Tom, on the other hand, watched his savings stagnate, fearing market risk. Years later, they met and compared their financial situation. Jerry's patience and willingness to invest paid off, giving him enough for a down payment on a home. Tom, despite having saved diligently, realized he had missed out on a potential growth. Moral of the story: do not fear to invest because investing wisely can unlock opportunities that simple saving might miss. Bitcoin are deflationary by nature. Did you know that some cryptocurrencies are like this? Let me explain in 60 seconds. Unlike traditional currency that can be printed endlessly, Bitcoin has a fixed supply of 21 million coins. This means no new Bitcoin will be created after the last one is mined. Now, the important point to understand here is that more and more people need to keep using Bitcoin because only then it will become scarce and its value will expect to increase over time. Then, with fewer Bitcoin in circulation and with rising demand, the purchasing power could go up, making it deflationary. So, while your traditional money loses value due to inflation, cryptocurrency like Bitcoin might just be getting stronger, but for that to happen, more and more people need to keep using Bitcoin. There should be new use cases for Bitcoin. Mutual fund investor. That is who I am since October 2023. Now, I am not an experienced investor, I am a very new investor. But what I have learned in these last 10 to 11 months is that I should never pay attention to my mutual funds every day. Because if I would do that, then I would keep worrying about the short term losses, or I would keep getting happy about the short term profit I would make here. Okay, why would I not worry about it every day? Why should I not track my mutual funds every day? Because I am not the one who is investing in the assets behind the mutual funds. I have given my money to an experienced person, and that person is investing my money for me. So that person should keep track of stocks and assets every day, but I should not. In the long term, I will make money. If you want to know the financial capabilities of a person, then do not base it on how much money he or she is making, but how much he or she is saving and then investing. Because even if they do have money and they spend that money on buying an expensive phone or buying an expensive car, then the price of that phone and the price of that car, that much money, will not be able to work for them. That money is just gone because the value of phone and the value of car will always decrease. A person with good financial capabilities is someone who do not work for themselves, but their money definitely works for themselves. Have you ever paid tax on the income that you never actually received? Let's talk about phantom income. Imagine if you have taken a loan from a lender and the lender forgives the loan. Then that forgiven loan may be considered income. Then there are certain investments which may generate earnings that are taxed even if you don't receive actual cash. For example, reinvested dividends. And then let's say you own a property that appreciates or generate rental income that is not yet received. It may still be considered for tax purposes. In all of these cases, you might not receive anything, but you still have to pay taxes on it. So it is important to understand the implication of phantom income for tax planning and reporting.